Hey everybody, welcome to a video on alternative ideas to monetary policy. I'm just going to talk about a few of the things that probably showed up at the end of your chapter on monetary policy, about some different ways we could maybe manage it. So first, let's start by reminding us of what the default is. In your intro class, we probably have a very simple idea where if there's an inflationary gap, something like this, where our current GDP is greater than Y bar, then we want contractionary policy to stabilize the business cycle. And if we have a recessionary gap, then we want expansionary policy to stabilize the business cycle. That is the simple overview of everything we've taught so far. Contractionary policy would be something like selling bonds and decreasing the money supply. Expansionary policy would be buying bonds and increasing the money supply. Now, are there other ideas than this? Of course there are. Let's talk about a few of the big ones. There's going to be the idea of should the Fed be targeting the money supply or interest rates. We're going to talk about the Taylor rule and a couple of pros and cons. And we're going to talk about inflation targeting. If your book talks about something else, I'm sorry, it's not in this video. Those are the three. So first, let's talk about monetarism. Monetarism is this idea that the Fed should manage a steady growth of the money supply, that we won't have active discretionary stabilization policy because there are errors in forecasting and in enacting policy, and the monetarists often make the claim that Federal Reserve interactions in the market make for more frequent and steeper business cycle swings. They should just stay out of it, manage the growth of the money supply, and the rest will be better off. So, what would that look like? Here's our money market. As real GDP increases, money demand will rise. As the money demand rises, we're going to have steady increases in our money supply. We'll keep the money supply growing to match the growth in GDP and the growth of the money demand. And it's going to keep our prices stable. It's going to keep interest rates stable. It's going to keep things simple. Now, this was a really influential idea in the 70s. Since the 80s and later, however, the M1 growth, that's our M1 money supply, sometimes is 10%, sometimes is like really low. It's not really that correlated with GDP growth because we've also had growth and we've had low inflation while the growth in the money supply has been all over the place. This is a lot of evidence that means that the support for monetarism has gone down. So it was a big idea, but it's not as influential now because it doesn't fit the last several decades of data like it fit the old data. We don't really do the monetarist thing. We manipulate interest rates, and the money supply is just a tool to target a specific interest rate. Now, next idea, the Taylor rule. It's an idea to replace discretionary policy with an equation. I'm going to put this little usually in here in parentheses because no one wants you to live and die by the Taylor rule. They just want the Federal Reserve to have to defend any deviation from the Taylor rule. It's a general guiding principle that can be deviated from in the case of emergency. So what is it? It usually looks something like this. Here's the federal funds target rate is going to be equal to, it's an equation, guys. Current inflation rate plus the equilibrium real federal funds rate plus half the inflation gap plus half the output gap. Now, what's the inflation gap? It's the gap between actual inflation and our target inflation. What's the gap in our output gap? It is the current GDP minus potential GDP. Now, notice those halves that I put there, they could be other weights too. It could be thirds, it could be 2/3, I don't really care. But some sort of number there to give them weight. And so if the current inflation rate is 3% and the federal funds rate is only 2%, and let's see, the inflation gap we'll just say is 1% and the output gap is 3%, well, you just plug all these into the equation and you would get that the target federal funds rate is 7%. The Taylor rule gives you an equation that tells you what the target interest rate should be. And anytime you deviate from that equation, the Fed would have to explain why they're leaving the rule. Good things about it, it's fast. We don't have to deliberate about policy. Another thing is it's predictable. It makes it easier for businesses and consumers to make decisions because it's easy for them to predict what's going to happen. Those are good things. Problem is that it has limited ability to respond to unique scenarios. The world is always changing, and a lot of economists think that there should be more discretion to match a changing landscape. So this limited response, that gives a frowny face. Now in practice, we don't use the Taylor rule. It does estimate or model a lot of the actual policies we've done, but we don't use it. Next is inflation targeting. And this is what we've been doing since 2012. This is current policy. The Federal Reserve has a 2% target inflation rate. It's a specific and a measurable goal. They can attain it, and we can rate their success in how well they've achieved it or how far they fall from it. And another good thing is that it gives us an inflationary expectations anchor. Like, we all can expect inflation to be around 2%. And as long as our Federal Reserve is competent and sticks to their target, well, we'll be pretty close to that. It does limit our ability to serve other goals, such as stabilizing a business cycle, potentially. It could be flawed by bad forecasting. There's less certainty about business cycle stabilization. It's harder for us to monitor other policies. These two up here, about the goal and the inflation anchoring, inflation expectations anchoring, those are pros. Those are things we like about this. These ones down here, these are all complaints that some people have about inflation targeting. But whether you like it or hate it, the people in charge have chosen it, and it is what it is. So, you guys, there's a lot we could go into here about different ideas and all kinds of different stuff. There's obviously some kind of consensus behind the current ideas, or else we wouldn't be doing them. Anyway, I hope it's helpful, guys. If not, too bad, but thanks for watching anyway. Happy econing.